Excellent. Good morning, good evening, everyone. Let's get started. My name is Charles. I'm the CEO of the dYdX Foundation, and I'm very excited to host all of you today, together with Han, which I will introduce in a few minutes, to host the February 2026 dYdX Analyst Call. So that's a monthly meeting we organize together with the community. We give updates on the market, we give updates as well on the metrics from the dYdX protocol, and we always invite as well a guest from our ecosystem. And this week we are hosting Han. So let's get started. Today we'll touch on the market backdrop as we usually do. We look at macro drivers as well on the market, understanding like what makes the market what it is today, and what could be potentially some avenues or directions it could go later on. We look at the dYdX protocol, the metrics. We do this on a monthly basis for you guys. We'll chat as well together with Han from Adaptive Frontier and the dYdX Council, and we'll look at also at different strategic initiatives within the dYdX protocol, and also double click on dYdX past events and upcoming events if you want to connect with us. So the market, as you know, has been sharply correcting since January 2026. We were kind of recovering slowly from the October slide of the market. And as you know, it takes some time. It takes quite some weeks for a market to recover from such a hit. Eventually, when we were kind of looking to start 2026 on the right foot, another hit came our way. So the market is definitely on the bear side right now. BTC is trading between 64 to 67,000. Same story for Ethereum or Solana, and the crypto fear and greed index has dropped to an extreme fear. So that's something we don't often see. Within the market, we will probably be always in a kind of a mixed feeling on the market sentiment side of things. But this time it's fairly clear. It's extreme fear on the market, and this is among the lowest level on records if we think of the FTX era or the COVID era. The Bitcoin ETF reflects this market sentiment. The flow are turning negative, but we will talk also on some other type of activities from pure institutional TradFi later on. So the macro driver are things that everyone kind of follow on the news on a weekly basis. Obviously, the Fed held the rate steady in its January meeting, and we have kind of a level of uncertainty regarding the evolution of those rates before the transition from Powell's teams and its term, which is expiring in May 26. There is always the tariff conversation, which we thought was kind of closing down slowly but surely and kind of repopped. So bringing another extra layer of uncertainty for many of the traders regarding the tariffs. So the markets are basically very sensible, as you may have seen on the news over the weekend. The court in the US has kind of challenged the tariff policy from Trump, and he will be trying to respond to that in the coming weeks. So this makes just more noise, more certainty, and those tariffs are essentially involving so many different parties globally that they are extremely important, and being able to calibrate their impact when actually these tariffs are popping up in different directions make it very hard for traders to kind of settle thoughts and a strategy for their trading on their desk. Same thing on the geopolitical scene with Iran, which remain a topic. As you know, a big representation of the US Army is present around the Iranian borders, and this creates again some kind of uncertainty, which is not good for the market. On the positive side, we have the CFTC, which has essentially invited a number of crypto executives from large projects to join its advisory panel. So we can see that the effort in terms of lobbying and the desire from US regulators all across the different spectrum of regulations in the US, all of them are engaged with the industry. All of them are building progress in terms of regulations for the industry. So we are at this period of time where the market are actually in a kind of a sick mode, but we can see that there are a lot of very positive signs coming up on the regulation side. So in my opinion, this is kind of a moment in time, which is obviously not pleasant, but definitely very interesting to see how it unfolds. In terms of industry developments, as I mentioned, a lot of positive signs despite a market which is definitely in the red. On one side, we've got CME Group, which has announced as a launch by the end of May 2026, 2024 crypto derivative trading. So this is a very important new product launch from a major player in the world of crypto derivatives, sitting more on the TradFi side of the industry, but essentially bringing at par the people trading on centralized exchanges and DeFi together with the people trading on the TradFi kind of rails. Having a market which is globally aligned and globally kind of trading at the same time will probably bring some more stability and allow all the participants to play on a fair kind of level, having exactly the same type of at least trading periods, which is very important. Pay attention to the CME numbers. In my opinion, it's a very strong sign for the crypto industry and the crypto markets. We still look at CFI and DeFi, and probably we will need to kind of upgrade our respective dashboards and respective data points, including this TradFi trading venues that is CME, because a lot of trading is happening over there, more than $3 trillion in notional in 2025, and the beginning of 2026 shows a growth of more than 46% year on year. It's just a lot of activity happening there from new money in the market, which is also an important point. Sometimes the crypto industry keep trading with the same type of participants, but every time you see CME or you see the N1IC or NASDAQ being part of our industry, this means more participants. This is new funding coming on the market. Again, a very contradictions between what the market shows in terms of pricing this week and what's happening in terms of regulation and infrastructure around. An interesting story and probably converging in more positive news. At least this is what I believe. On the CFTC and the SEC, both those regulators have been joining forces to ensure that there is the right regulations and enabling this 24/7 market trading for perpetuals as well as spot. So really a kind of joint set of rules for all these market participants. On the next slide, we'll touch on the fact that dYdX is built for this kind of environment. As you know, dYdX is focusing on perps since 2018. dYdX since the beginning has been built for 2027 and always on trading. So seeing TradFi playing in the league of dYdX is a very positive news. We see also regulatory convergence, the fact that perpetuals products are now recognized, understood, and accepted by regulators globally. Really kind of build and strengthen the narrative and the value proposition of dYdX, which has been built again for years in the past. So we'll look now at the protocol metrics. This slide, we try to keep it very similar in terms of design, so you can try to keep and take some snapshots of the evolutions of the numbers since the beginning of dYdX, between the version 3 and the version 4, which is actually in place right now. Close to $1.6 trillion of lifetime volume, $65 million of protocol fees have been distributed. Today, there is 286 markets tradable on dYdX, but historically, more than 386 markets have been listed on dYdX. And the difference between these two numbers is essentially the community, which is kind of proceeding to some kind of cleaning and tidying the order book whenever a market is not relevant anymore or does not provide enough liquidity. The community via governance will essentially kind of put aside those markets and unlist assets which are not in the flavor of the quarter. The number of dYdX token holders keep increasing. This is an important data point for all of us. People pay attention to the derivative market, people pay attention to dYdX and essentially increase their exposure via the dYdX token. So this number keep growing steadily, and that's a metric I pay a lot of attention. Even though the markets are tough for all of us in the crypto trading industry, knowing that the mind share and the attention remain around the protocol via a growth of dYdX token holder is a very positive sign. So far, close to $50 million of staking rewards have been distributing to stakers. This is an important also data point. We're going to come back to this later on. And more than 34,000 dYdX token holders are actually staking. So that's also a very positive sign. The security, the performance of the chain is where it is today, thanks to all the validators as well as all the stakers making sure that dYdX remain a highly secure venue as well as a highly performant venue for crypto traders. So the month of January has been complicated for all the industry, and this is a kind of a sentiment and trends we've seen all across venues. So over the past 30 days of the month of January, $9.48 billion of trading volume has been recorded. So this is definitely a pullback from the $16 billion recorded in December. But this is kind of in par with the kind of trend we've seen amongst our peers, whereas when the sentiment of traders is low, eventually the overall activity of protocols and crypto trading venues goes on the lower side. We're not going to come back to the price of the different assets. The volatility helps dYdX to keep the level of fees at a reasonable level, but definitely this market sentiment is kind of weight on the graphs here, as you can see. One metric we would like to share with you here is daily active traders, and that's an important one as well. Again, even though the market is at present within a corrections globally for all the participants of this industry, we see the participation holding still steadily within dYdX. The traders base did not capitulate, and even the sentiment moved to extreme fear. We keep having very steady number of traders which will keep expressing their sentiment on the market, maybe in a different size and for different topics, but the mind share is there and the number of traders remain stable over time. So that's a good sign also for the dYdX ecosystem, showing that the participation remain high even though the market is complicated and a low mood pattern. In terms of stake supply, as I mentioned earlier, the number of dYdX token holders growth, as well as the number of dYdX stakers. We see a steady level of security and participations in terms of staking and bonding within the ecosystem. Every time people hold dYdX tokens, they have the option to essentially stake those tokens with validators and receive a share of the revenue generated by the protocol in the form of USDC. Essentially, rewards when you stake are not coming from token inflation, but really from the fees generated by the protocol. Talking about staking, we need to speak about APR. So here today, the staking APR is around 3.3%. This is paid in USDC, as I mentioned. This is not inflationary, and all the rewards are coming from the protocol fees, not from token emission. This APR varies on a daily basis together with the level of activity of the protocol. The more volatility on the market, the more trading activities we observe, the more protocol fees are generated. Therefore, the flow to stakers in terms of rewards increases. So you can see here in the graph below from our friends at Numia how this kind of protocol fee generations evolve and how the distribution evolve also to the stakers, but also to the buyback program, which we mentioned in the past calls. In terms of protocol maturity and resilience, it's good to see that even though the market is in a large deleveraging trend market-wide, traders' participation is holding strong, and we see the stake supply remaining stable, as well as the flow to traders in terms of rewards staying also in reasonable levels. I'm now very excited to be joined by Han Chang. Han is the CEO of Adaptive Frontier. Adaptive Frontier operates in both centralized exchanges and decentralized exchanges. They are providing liquidity and services to various projects all around the industry. But also Han is part of the dYdX Foundation Council. You can think of the dYdX Council as the foundation board. So we're working closely together on everything related to dYdX. I'm very excited to have you join us today. So thank you for making the time, Han.
Absolute pleasure, Charles. Glad to be here.
So we will be talking about market making evolution. We will be talking about new asset class, risk management. Let's get started. We prepared a few questions for structuring our conversation. In the context of Adaptive Frontier, you're very much involved in both sides of the industry, between centralized exchanges and decentralized exchanges. And there is a big narrative around the market that the kind of activity and level of activity between centralized exchanges to decentralized exchanges is migrating to decentralized exchanges. So we might have a bias at dYdX, and I wanted to double click on this with you because you kind of sit on both sides of the trading world over there. What are your thoughts on that?
We definitely see exactly what you're mentioning. So I don't think the bias is unwarranted. It's absolutely true. We see a steady migration of volumes to the DEXs. Based on our rough numbers, I believe around 4% of the total volume in crypto in January 2025 was DEX volume versus a little bit under 11% now in January 2026. There's a very clear, it's steady and slow, but it is very consistent movement of the volume from the central exchanges to the perp dexes in particular. I would say the growth rate is actually quite healthy. The centralized exchanges have actually decreased by 4% year over year from 25 to 26, and the perp dex has actually increased by over 120%. So yeah, what you're seeing is absolutely correct.
In terms of risk management, Han, when you trade on centralized venues versus decentralized venue, there is obviously centralized venue are possibly a little bit more stable than decentralized venues. They sit on centralized. I see you smiling. We're going to double click on this. And then we see decentralized venue, which are living on blockchains or different layers. How do you adjust your risk management between these two different type of venues?
The risk management is very similar from a pure trading perspective. On the smart contract and self-custody setup, I think that's actually where a lot of the different risk management takes place. So from a pure trading perspective, obviously the API connectivity is the most important part. We actually find that decentralization improves the resilience, but lacks on the latency side. As from a maker perspective, that's a little bit dangerous in that, our resting orders on the order book might get picked off. But as long as the response time is pretty reasonable and the toxic flow is handled well, we can deal with that and it's not an issue. I think a lot of the risk management is more on the smart contract side, where from our perspective, we rely mostly on just a strong and diverse third party auditor pool, as well as just Lindy infrastructure in terms of being around for a while. dYdX definitely checks that box as being the OG perp dex. So that is a very stable area for dYdX, which is fantastic. And on the self-custody side, we have to make sure we protect the private key, either through some combination of MPC, multi-sig, hardware wallet. dYdX has the permission key feature, which gives us a lot of comfort as well in terms of making sure that our private keys are safe. I would say the final concern would be actually more on the supply chain side of things in terms of particularly the SDKs and the signature generation libraries. Those do need to be closely vetted. dYdX actually very proactively found a vulnerability in the Python library for signature generation and took care of that ahead of time. And from my understanding, actually, no assets were lost. And so that is fantastic. A proactive security from dYdX, which I definitely much appreciate.
I suppose you do quite a bit of arbitrage. And how do you essentially include the latency, which can be variable in both centralized exchanges and decentralized exchanges, into your trading execution?
Some of it might be a little bit on the proprietary side, but I'll share what I can. What we see is actually that the decentralized exchanges have a lot less toxic flow, particularly around some features that most of them have, including dYdX, which is actually some sort of cancel priority to help makers have a little bit more stability. And so I think that is a very good feature. And in particular, also, the centralized exchanges are just really moving towards much more TradFi infrastructure. Like a lot of them are releasing features like SBE, which is a simple binary encoding, and that really reduces the latency, but to a level where it's probably not useful for market microstructure. It just benefits the lowest latency players. We definitely stay latency competitive, so it's not an issue. But in our opinion, it's actually a little bit of a waste of time and effort for everyone because, yeah, basically all the low latency players like us will just spend the time and effort to go integrate all these new lower latency protocols. But does it really actually help the market microstructure and actually help retail traders? Our assessment is actually no. So this is where I believe that the perplexes are doing a much better job in terms of taking care of the retail traders, and that's where I see the retail flow definitely going towards.
That kind of fit very well with this growth of the perps exchanges volumes in general. And I think you explain or you give us one element on the top of everything we can think of, like why this migration comes, more innovation and more care of the retail trading flow is being brought to the market by the perps industry on the DEX side. Talking about the perps, we've seen coming equity perps. The prediction market are very, very hot topic right now. All of these markets usually start with a retail flow, and eventually they are important to kind of consider for the institutionals. How ready, in your opinion, are the equity perps as well as the prediction market for institutions?
Institutional players range pretty big gamut in terms of what their tolerance is for these type of products. I think on the prop trading shop side, it's totally fine, but in the very big institutionals, I think they're going to have a lot of concerns regarding the KYC of counterparties. I think that's a huge challenge for them, where a lot of these big institutional players have compliance teams that are still unwilling to face unknown counterparties in the order books. And so I think that is going to be a drag on adoption for equity perps until that side of things is figured out, either through either regulatory clarity or some sort of compliance layer that allows these institutional players to understand who they're facing. I would say the other issue is probably effective custody solutions to protect wallets. Basically, especially on prediction market side, for example, like Polymarket, trading still requires directly including the private key in your algos, which is a major security hazard. For example, like dYdX, because of the permissioned key feature, they allow you to just generate API keys that allow you to trade, but don't allow you to withdraw or transfer funds. The prediction markets don't even have that infrastructure yet. So until that is solved, I think institutional adoption is going to be a lot more challenging.
We are still the beginning of the year. I know it's a little bit late, but we have the Chinese New Year happening right now as well. What is your outlook for 2026? How do you think the market will keep structuring itself? How do you think the volume could evolve? And where do you think all this liquidity will eventually settle on the traditional market, the perps, as well as these new markets such as equity perps and predictions market?
Yeah, that is indeed the $1 million question. So we're delta neutral. So from a pure like market direction perspective, we're relatively agnostic and we honestly don't quite know. My personal assessment is that from a pure market structure perspective, I expect volumes to be relatively muted until there's some sort of new catalyst. At the moment, unfortunately, there's just much more interesting products for retail to trade at the moment, which is almost everything else. Like precious metals, commodities, AI stocks. There's a lot of things to trade that are a little bit more interesting than crypto at the moment. However, I'm still very much long-term bullish. I do feel like, if there's any sort of hyperinflation in some sort of country or private capital, basically, if private property is commandeered by any sort of sovereign, I can see that being an issue as well. Like, for example, if a country decides to ban gold due to, I don't know, capital controls or something, then I see a huge shift back into Bitcoin. That's where Bitcoin absolutely excels in terms of self-sovereignty. And so the world is in a relatively unstable state at the moment. And so some sort of hard asset like Bitcoin that doesn't require physical custody, I think can have tremendous value. In terms of where the liquidity settles, I definitely fully expect the steady shift from centralized exchanges to decentralized, definitely on the retail side, to continue. I think in particular, after the October 10th market crash, there's just a lot of questions regarding what exactly happened, particularly on Binance, but even just other centralized exchanges. I think decentralized exchanges with the self-custody aspect just gives retail a lot more comfort, and understandably so. And on the TradFi side, I do see regulated venues like the CME getting more traction as well. And so I am a little bit worried that the centralized exchanges are getting squeezed from both sides, where institutionals will go to like the CME, SGX, etc., whereas retail is going to go towards these perp dexes. So, but let's see how it goes.
I love this tech. Maybe the centralized exchanges eventually will be challenged. We should follow on this. Yeah. We'll go to the next slide. Han, thank you so much for taking the time again today. This time we'll go for a rapid fire. I know you're kind of on the grill today and so many questions coming your way, but I really want to make sure that you can share some of your experience and knowledge, and as well giving us more insight on what is your role at the foundation. But before that, we'll come back to the market and the kind of trading conversations between equity perps without TradFi pricing infrastructure, which is the case today, somehow a very nascent one. Is anyone actually hedging the after-hours risk for equity perps properly?
We looked into it ourselves. My personal guess is actually unlikely. Many venues actually lock prices within like a 3% band in the after hours, so risk is lessened. Although, start of day, end of day, there could be some volatile, so that could be a little bit dangerous. I'm guessing a lot of shops might actually just flatten before end of day. I think that's actually the safest method. Generally, the volume after hours is low anyways, so it may not even make sense. And then there's always the possibility to hedge on other 24/7 venues, but the liquidity really thins out. So yeah, my rough guess is likely not at the moment. Yeah, and as long as you reduce your position size, maybe to zero or maybe just a small amount, I think it's negligible. So
As we told a little bit a few minutes ago, many traditional trading venues in the US are basically working on trading 24/7. So again, we see the world and the industry of crypto being ahead on this topic, and probably putting pressure as well on these TradFi players to say, hey, you have to build up your game. We can't be trading 5 days a week. We can't stop trading at 4 p.m. anymore. Settlement should not be taking 2 to 3 days. So it's one of the many positive kind of support and contribution that the industry brings to finance in general. Is crypto is essentially driven by highly performant technology, and this just pushes TradFi to beef up their game. So that's a great one. In the world of binary options models for prediction market, does it make LP capital allocation fundamentally different from standard pairs?
I think it's extremely different. So the current situation is that the prediction market volume is still an absolutely tiny fraction of the perps volume. Depending on the product and expiry timeline, there is actually a huge amount of capital efficiency differences in prediction markets. So, for example, the 5 minute crypto up and down markets that recently just launched on Polymarket, these are exceptionally capital efficient. And on the flip side, the markets with a very long time to expiry, I don't know, maybe like the 2028 presidential election type of markets, are extremely not capital efficient. So I think the range is just much greater. And depending on what strategies you run and which basically markets you decide to play in, that really dictates how much capital efficiency that you can see.
One thing LPs are underpricing when they come from SEX to DEX for the first time.
There's a lot of little nuances that really make DEX trading a lot more attractive. I think the most obvious one is the token rewards. We personally don't price them in. We know some people that price it in, but that obviously, just adds to your P&L when you trade. The flow is just much more different and generally a lot less toxic. There's just going to be a little bit less competition. And actually, I think one maybe lesser known and less P&L focused, but I think just as important factor is actually just trading on DEXs definitely pushes forward the industry in terms of more decentralization. And I think that is, I would say, underpriced as well in terms of just the impact that you can have on the industry.
We are all seeing this migration from centralized venue to decentralized venues. What could be a big unlock or catalyst accelerating this trend?
The trend is slow, but it's steady. Unfortunately, the major catalyst I can think of is obviously some sort of like major centralized exchange fraud or hack. I don't wish that on the industry, but I mean, I think that would shake people up quite a bit and make them realize the importance of self custody. I think regulatory clarity helps as well. I don't think it'll be a huge catalyst, but it will allow more institutional players to come in, and I think that adoption will further, get more retail to be involved as well. One crazy idea is actually AI being a dark horse catalyst. Agents are definitely going to prefer, stablecoin rails just because that's a lot easier for them to transact in over like TradFi payment infra, and so I can see a crazy world where AI agents actually prefer to use perpdexes for whatever reason as their like banking system or something along those lines. But unfortunately, it does seem like barring some sort of centralized exchange crash, I think the migration will be more on the slow and steady side.
I agree with you on the AI agents. I think decentralized finance is offering just the perfect toolbox, a very welcoming toolbox for AI agents. And it's a very hot topic, but we definitely see some growth happening there in terms of infrastructure, in terms of use cases. So we should not think it's going to basically blow the numbers overnight, but it's definitely kind of contributing to the natural direction of the industry, moving away from centralized venues to decentralized venues. Han, I'd like to double click on your role at the dYdX Foundation. Can you describe your role at the dYdX Foundation in 60 seconds?
I basically just help dYdX stay updated on the perp dex as well as the centralized exchange landscape. I provide feedback on product strategy, trading experience, both from a retail personal account as well as an institutional like company account perspective. And yeah, I assist with the foundation governance.
Thank you for that. Always a pleasure to sit down with you, brainstorm, and work on everything strategic at dYdX. We release at the dYdX Foundation. I'd like to thank Winnie, which has been really at the core of this exercise, the 2025 dYdX ecosystem report. What stands out to you when you first looked at it?
Absolutely. The metrics just continue to move in the right direction. I think it's fantastic. I think the brand is even more well known than before. Yeah, I think the beauty of it also is just that dYdX continues building regardless of the bull or bear markets.
What is exciting for you at dYdX for 2026?
I'm very much looking forward to RWA perps, the launch of prediction markets. I think also, I think there's going to be additional flow coming in from existing and new partners. And so, yeah, very much looking forward to that as well.
Talking about new partners, we're going to touch on this in a few minutes. Han, thank you so much for joining us today. It's a pleasure to have your wisdom, your experience shared with the community. We are very grateful. Thanks again for coming.
Pleasure's mine, Charles. Really appreciate you having me on.
We'll move on to strategic initiatives, as we mentioned. Han was talking about partners and how these partners can contribute to growth within dYdX in 2026. The one integration I would like to highlight to you this month is a Coiner integration, which is a very interesting one. I really invite you to have a look. Coiner has been integrating and developing dedicated dYdX trading bots on its platform. So it essentially enables retail users to automate strategy execution on-chain directly on dYdX via the platform. So there are 4 different types of bots which have been developed by our friends at Coiners. You've got a grid trading bot, as well as a DCA, copy trading, and a very interesting one, which is a trading view signal execution. So we see a lot of these initiatives of integrations growing over the past quarters within dYdX. This is one of the latest. You remember, of course, Foxify, Crypto.com, Tor wallets, the list goes on. This one is an interesting one. I really invite all of you to visit dYdX.coiner.co, and it's going to give you a flavor, if you're not already an API trader, how API traders are essentially getting involved with dYdX, and this kind of fills this gap. So a very, very interesting investigation for you to look at. So welcome to the dYdX ecosystem, to the Coiner platform. Another strategic initiative which is ongoing is a Surge. Surge Season 11 is ongoing for the month of February, and there is a number of essentially incentive designed and approved by the community, which you really want to keep in mind whenever you decide to go for a trade. So the 50% fee rebate continues through February, should you be a UI user or an API user. 2 things very important also to keep in mind, that there is 0 maker fee and 0 taker fees on BTC and Bond perps. So this is ongoing for the whole month of February. So you still have a few days to benefit from this campaign. The liquidation rebate program is still ongoing. Remember, there is $1 million which has been allocated to this liquidation rebate programs. So every month, different users will benefit from that. We've got also a competition going on together with Voltrade, an Ethereum USD trading competition with more than 15K USD in the price pool. And the affiliate program keep thriving. It has been bringing great results thanks to the work of many, as well as the support of the community, enabling every promotion. So there is, for the months of February and March, 200K US of affiliate booster program, which has been allocated. So thanks to everyone sharing great words about dYdX and bringing in new users and additional flow. We'll now double click on dYdX at events. There was earlier this month an event in Dubai where dYdX was essentially recognized as the best decentralized perpetual exchange for 2026. So we'd like to thank our friends at AIBC and Sigma for their kind awards and invitation to this event. I was attending EVE Denver also. It was great to reconnect with many of the builders of the space and connecting with the trading side of the industry as well as the building side of the industry. Next month, and on the next slide, we will be organizing together with our friends at Tokenized Capital Summit an event alongside the Token 2049 Dubai event. So this will be at the end of April, on April 20th. We've been organizing those events in Abu Dhabi last December. It has been like a massive success, full house, and we're kind of doubling down on this flow. So it's an event only for traders and people from the trading industry. It's very, very much curated in terms of content, in terms of attendees. And I really invite you to join us for this one again during the month of April in Dubai. I think we are touching at the end of our monthly analyst call. I'd like to thank you for all your questions, participations. I'd like to thank you, Han, again, for joining us and joining this conversation. Always a pleasure. And thank you as well to Winnie for preparing and organizing this analyst call. I wish you a good time on the live side because the market is tough. We will keep building when this market gives us some time to be ready when the market pops up again. See you all next month for the next dYdX analyst call. Thank you, everyone.